March 19th, 2024. We had two open gaps early in the day today. We had, I looked at it as this open gap. And then we had this one, which was a lot more obvious. And we ended up getting even more open gaps throughout the day. But I think the most important thing is when you get two open gaps early in the day, the odds of it being a trend day dramatically increase. And you can see, this is all examples where you had two early open gaps, and there's a trend. There's a trend. Trading range day got an early trend. You ended up getting a reversal. It's kind of a trend. There's a trend. There's a trend. Trend, and then it's trading range. So big bull trend. So you can see that a lot of times when you end up getting those two open gaps, you end up getting least a swing. So I think those two open gaps are really important. We also, this was less important, but we had a wedge, 8, 20 or 18, however you want to look at it, and then 26. So essentially this, oops, this, and then we got a measure move up of that wedge. This was one of the targets I think we were testing at the end of the day when we started to get this buy the close rally. But I thought it was more important that we try to get to the all-time high. We didn't end up getting there. It's somewhere over here. We didn't end up getting to the all-time high, but I thought the all-time high was, potentially really important today. Bar one, a bear bar, but not a very strong close. It's not really a very good, bar to sell the close of. It's a gap down, so bears are hoping to get their first open gap of the day right here and keep it open, and potentially, get some sort of big bear trend day. That's their goal, but probably not going to happen. Let's see the follow through, and you get kind of disappointing follow through on bar two. Or it's not that disappointing, but it doesn't close below one, and it's fully overlapping with one, and it kind of looks like two legs down. If you look, bar one went down and then pulled back, and then bar two went down. So it looks like a two-legged move. So one pullback two could be a second leg and starting the bottom of a trading range, which is what it ended up doing. Bar three, it's essentially just a doji bar. It's a potential buy for the low of the day. You could argue 1-2 sell climax on the open, and a swing buy above three, just basically hoping it's the low of the day. You're not going to win that very often if you do, but whatever 10, maybe 20% of the time you win that, you'll do pretty well, as you can see. So that's not like obviously wait for follow through. It's just more of a theoretical trade than anything. Bad follow through on four, which is relatively expected since there's a doji bar. You can see, and you sell the closed bears, sell below two, disappointed three, getting out during four. And then another outside bar on five. Just an outside bar on five. So we have an outside bar five. It just kind of looks like an expanding triangle, just a trading range open, really. More bull follow through on six, but we've had, three basically dojis and then bars with big tails six. So this does not look like the start of a big bull trend. This looks like a leg in a trading range. And it's the same thing with seven. Again, weak channel and essentially just a trading range. It's probably looks something like this on a lower time frame, maybe a little less steep. But it probably looks like, some sort of bull channel. Let's look at it. So from 9:40 to 10 o'clock, it's probably some sort of weak bull channel, and bull channels are bear flags. So you have to expect, so this, does this look like a leg in a trading range to you, or does this look like a bull trend? This looks like a bull trend. This looks like a leg in a trading range. So when you're seeing this, you should be thinking, well, this looks a lot more like a leg in a trading range. Look at all these tails. We're probably not going to go very much higher. And you get the reversal down on 8. 8, a double top bear flag with 1, maybe 40% chance we get a measured move down of the opening range. But it's a doji bar and following 5 straight bull closes. They're not good bull closes, but they're bull closes, so really not worth it. Bad follow through on 9, just a doji bar, but enough, basically any bulls who were long buying for any reason. What bulls were hoping for was they were going to end up getting essentially a give up bar from the bears. That they, occasionally what you'll see is if you'll have like kind of 4 or 5 or 6 of these kind of bars in a row, at a certain point, the bears will just give up and decide they'll sell higher. And you can see they were trying to do it again here. They were trying to get the bears to give up and then get a push towards the all-time high. We ended up pulling back and then trying, but you can see the bulls were really trying to get the bears to give up. And instead they just couldn't get a bull bar closing near its high, and the bulls give up, and this turns into a final flag. So the bulls giving up is what's going to cause this. And, the bulls giving up is what causes bar 10 as well. Bulls were hoping that the bears were going to give up, and instead they get a bear bar, and the bulls are disappointed, and so they're going to exit, and that's what's causing bar 10, to get down here. But an important thing to remember about bar 10 is it's not a good sell. If you're selling down here, you're selling the bottom of a trading range, and after this many bull closes, we're probably going to get some sort of bounce up. And this bar was mostly bulls exiting, not really bears selling, so it's really not a great sell below 10. If you did take it, you can see the bears on 12 were quick to get out, like they got to try to get out as fast as possible, but I think that, it's much better to just wait and see if 11 is also a strong follow through. If 11 is a strong follow through bar for the Bears, then great. It's potentially a bear trend. You have this open gap, and you could be looking for a second one. So good for the Bears. But instead, you get a reversal up 12. It's a double bottom with 3, a potential low of the day. We still haven't broken below the low of the day at 3. So neckline 311, or sorry, double bottom 311, neckline 7. Kind of similar. You can buy, go for maybe 40% chance you're going to get the measure move up, but it's usually hard to hold through the whole thing with these double top and double bottom flags. Bad follow through on 12. You can see bulls tried to get a strong reversal up, but we just ended up back in this area where bulls bought and ended up being disappointed and they were selling out. So you get disappointment on 12. And then 13, I was trying to think. So when 13 opened, I was considering getting out at break even on my buy above 11. I did buy above 11. But a lot of times this ends up happening where it doesn't end up going down and you just end up getting a bull bar closing near its high. So I ended up staying long because I figured if we started to rally, the odds were good we were going to do something like this. And I'm trying to think of the logic for a bar like bar 13. Because, you essentially, if you're long down here, you want 13 to close above the 11 high, because what it shows is that bulls weren't exiting at break even. They were instead buying. So the logic for it would be, I suppose, bulls start to see other bulls buying and they keep adding. But I can't imagine, there's a ton of bears looking to buy back shorts down here because they're probably already out. But either way, 13, double bottom 11. So micro double bottom 11 and bigger double bottom 3. Neckline for this double bottom is the 12 high. So reasonable buy, looking for a swing up, maybe a measured move, something like that. And no surprise, the measured move up from the neckline brings us right to yesterday's low, which is going to be a target. Good follow through for the bulls on 14, not quite able to close above the moving average, but we're clearly always in long. We probably started out today always in short from the gap down, and we never really quite flipped to always in long in the rally up to 7. And then we got another leg down, and always in bears we're going to exit above 11, but probably always in long 13, definitely always in long 14. More follow through for the bulls on 15. It has a tail on the top, but it is a close above the moving average, which is important. And then you have 16, tail on the bottom, tail on the top, but still the consecutive bull closes above the moving average, and consecutive bull closes above the moving average is very important. I thought there were 2 ways to look at a potential gap here. The first way was we obviously got to break out of the 7 high during 14, 15. So were those bears, they're going to be able to scale in and make money. Basically, once we started to get up here, are we going to get back to this high? And no, we never got back. So that's one way to look at it. Another way would be body gaps, meaning it's essentially like on a line chart. Line charts only pay attention to closes. So are we going to overlap with this one high? So we essentially the one high is the breakout point, but the open of 1 would be the breakout point on the line chart. And are we going to overlap with it with a close? And you can see we did not. The close of 18 does not overlap that one high. So that is an open gap. It's easier to see on a line chart. It's not much easier to see at all because of this, but I guess I lied. It's not easy to see on this. I didn't look beforehand, but some open in here and then open gap. It's easier to see. It's usually easier to see those kind of gaps on a line chart, but I suppose it's easier to see it on this chart today. 17, bad follow through for the bulls. It's a high 1, doji bar. It's clearly always long, okay to be long. 18 essentially tested yesterday's low within 1 tick. We'll probably have to actually touch it, but touched around yesterday's low and found sellers. Do you sell below 18? Nope. I think it's too strong. It's probably a minor reversal and we could get a deep pullback. It's very possible we could test all the way back to the 12 high and maybe even a little bit lower. So, it's kind of hard to want to hold. I think if you bought, I did buy and I exited below 18. I thought that was fine. This was kind of a difficult day to hold through because there were so many reversals. It's hard to stay long below 18. If you buy again above 19, hard to stay long on 22. You can buy again above 24 or buy the breakout above the 20 high, but hard to stay long. And if you're buying in here, I wouldn't buy at 28, but I'll get to that. But 30 was an okay buy, but you're probably exiting below 32. Maybe you buy the breakout, and then you can buy the surprise above 34, expecting potentially a measure move up. But anyways, 19, a high 1 buy. It's okay, but I don't know how much higher we're going to go without a 2-legged correction. So my worry was 18 might get a second leg sideways to down, and I was going to get shaken out of the trade buying above 19. So I just decided to wait. I said, if 20 is a good bull bar closing near its high, I'll buy that. Instead, we get bad follow through on 20. an inside bar on 21, another inside bar 22. So it's an II pattern. It's an attempt at a final flag for the Bulls. But look at the follow through 23. It's not really ideal. The Bears wanted to follow through closing, they're looking at it probably as a double top with 18. So they wanted to close below the breakout point, which it would be the 17 low, or the 19 low. Maybe even the 15 low. The 15 low would be the start of the channel. So, right, spike 13, 14 here, and then channel phase. And we end up getting a break back into a spike phase. But anyways, 24, a bull bar closing near its high. It's, it didn't close above the 20 high, which is a bit disappointing, but it was still a good bull bar and a surprise bar up. So reasonable to be long. More follow through on 25, another tail on the top. So a little bit disappointing, but still okay to be long. 26, a bear doji bar. I think if you're long for any reason, you get out below 26 and you just wait to buy again above a bull bar, except for the fact that this is a wedge, right? And when you get a wedge, what are you going to get? Probably 2 legs sideways to down. So I think you probably got to sit out of 28 unless you have a wide stop somewhere down here and you're willing to scale in. 27, bad follow through for the Bears who sold below 26, relatively expected. You can see bulls who bought all the way up to this high tick because at some point this was on its high and some bulls decided to buy. And so they're disappointed in this. And you can see they were selling, but 27, not good follow through for the wedge. But I don't think you buy 28 because you're expecting 2 legs sideways to down. High ones generally lead to deeper pullbacks and second entry buys, etc. So buying above 28, you know that you're probably going to get a deeper pullback. And if you buy above 28 with a stop below 28, look what happened. It stopped you out and then started to go, which is really common in trends for high ones if you use tight stops, especially after a wedge when you're expecting 2 legs sideways to down. So outside down 29, because just a lack of buyers above 28. No one wanted to buy above 28. They wanted to buy below 28. They know that buying above 28 is going to lead to a deeper pullback most likely. And that's what you get on 29, the deeper pullback. In a reversal up 30, high 2, good buy on above 30, I think. You have a 2-legged correction after the wedge. You can buy, taking a chance we start to get a breakout above the wedge. And as far as selling on days like this, when you start to have open gaps here, open gap here, you should stop selling. Just don't do it. It's not going to end well. Look at sorry, I get a little tangled with my words sometimes, but look how much money has a stop order bear made today? What if they sold 8? It's really hard to do, but if they sold it, they could have maybe made like a point, but you're gonna have to get out above 11. If you sold 10, you lost. If you sold 18, you lost. If you sold 22, you lost. And all of them pretty much immediately. So do you think suddenly everything's going to change and you're going to start making money selling? You sell 29, you lost. And then you're going to sell again 32 after every single stop order bear has just continuously gotten stopped out so far today. Instead of doing that, if you did that today and you sold a whole bunch, look at the places where your stops were. So go back and figure out where your stops were. And I'll bet that if you sold, here, your stop was above here. If you sold here, your stop was right here. If you sold, in here, your stop might have been up here or it might have been up here. Either way, look at all these spots. They're good spots to buy. They're breakout points. So if you're a bear who sold a bunch today, I would challenge you to, in the future, look at these, when you see these kind of setups, instead of selling when you have open gaps, just start to look to buy on stops in the area where your weak bear stop was, because those will become logical bull entries because they know bears will be buying back shorts in those areas. So bulls will look to buy as well. Follow through for the bulls on 31. 30 was a bit of a bigger bar, so a bit bigger risk. Bulls buy the 50% pullback instead of buying directly above it, but I thought okay to buy above as well. Follow through on 31 is okay, not great. You still want more follow through, and you get a reversal down 32. It's, you can call it whatever you want. It's double top, it's a wedge, whatever it is. Don't take it. Wait for good follow through, and I probably want good follow through in a retest before I'm selling anything. So there's not really much 33 can do to make me sell. And you get bad follow through anyways. And then a big outside up bar 34, bulls buying the breakout, trapped out, buying for any reason. Follow through for the bulls on 35. Really climactic pair of bars, but still reasonable to think we're going to get a measured move up. And then more follow through, not more follow through, but a pullback on 36, but I still think okay to buy above 36. It's a high one in a spike phase, which is a little different than this high one because this was on a wedge. But, instead we're getting a high one in the spike phase of the channel or of the bull trend. So okay to buy above 36. And you can just look at it as buying above 35 during 37. Okay to buy above 37, 38, 39 is probably okay, but it's really climactic. You can see we've had, essentially Let's do it this way. Essentially a channel all day, and we're getting a climactic breakout above it. We might go a bit higher, and it's still theoretically by the close. But when you see a bar like 39, 60% chance it's the end of the trend, 60% chance you get one more leg up. Bad follow through on 40. So any bulls who bought, a lot of bulls buying the close of 40, trying not to let it trigger and trying to race straight up to the all-time high. But instead, we get kind of bad follow through on 41, and traders end up dumping their longs, causing 42. Surprise bar up on 43. I suppose some bulls were buying the close of 42, trying not to let it trigger below, but instead you get a surprise up on 43, but bulls sold it. We didn't quite reach yesterday's high. I'm not sure what magnet 43 was testing, but I'm sure it was something. But it's a big double top for the bears, but again, you don't want to be selling anything. I think at this point, we're going to go sideways for at least an hour or two, and then maybe try to get a buy to the close rally. That was basically my thoughts. And we ended up getting, an expanding triangle as a final flag. Occasionally you'll get a sell off after this, but I think expecting sideways for the rest of the day was probably the best bet. If you didn't make any money through here, and you were trying to trade in here, probably rethink your strategy, because this is where you want to be trying to make money, not in this kind of a mess. 46, so at least rethink your strategy if you're trying to trade stop orders. 46, 45, a doji bar, a couple legs down, reversal up 46. But, it's a wedge, 42, 44, 46. So expect a little bit sideways to up, but we might have to get to the moving average. Inside bar 47, probably not the best buy. A bull bar closing near its high 48. I think you can buy 48, but I still thought, big wedge, climactic bar, we're going to be going sideways for a while. We're probably not even going to reach the high of 43. So I thought we were going to get a lower high and stay within a trading range there. If you bought above 48, 49 is not really the follow through you wanted. Buyers below, it's a bad low one. You can see during 50. But a doji bar 51, and then essentially another doji bar 52. Bulls are going to start to give up at some point and think that we're going to head to the moving average, which is what happens on 53. A high one, 54, but not all that good. At this point in the day, you should just be sitting and waiting for a consecutive pair of bull bars to buy above. And then, 54, like I said, high one. Second leg down, 55, 56. Reversal up 57. It's a high two, but technically a high one, I suppose, but I don't really want to take anything with this outside up bar. Bad follow through 58, but probably buyers below near the moving average. So pretty reasonable to buy below 58, I would think. During 59, which ends up being essentially a high one, follow through 60, 61, 62. And this is again what I was talking about here, I think, I thought that bulls were trying to force a give up bar, because, you'll see it occasionally. I don't think I have any examples of something like that. This might be, this is not as good of an example, but you can get the point where it's a couple of smaller bars and bears aren't quite convinced, and then you get another one and they can't handle it anymore, and they say okay, and they get a pop like that. So the bulls who were buying in here were hoping that they were going to get a pop, but basically one of two things is going to happen. Well, I suppose one of two things is always going to happen. It's going to go up or down. But if bulls get the pop, then they're probably going to scalp it at the new high. And if it starts to stall, traders are going to just quickly give up. That's exactly what happened on 65. Is the bulls, they were hoping. They just didn't end up happening, and we were too high in the trading range. And so they said, fine, whatever, we're going to give up. And they gave up, and that's what caused the 65. Bulls saying, we'll just buy lower instead. Maybe an okay swing sell below 65, to be honest, but disappointment 66, relatively expected. But you should get a couple legs sideways down. It could be its own wedge, maybe 1, 2, 3, some sort of truncated wedge or something. But it's really just an expanding triangle, I think. 66, bad follow through. Doji inside bar 67, low one short. Follow through 68, but we're probably going to test at least the 67 low, bad signal bar. And that's what we do on 69. Big reversal up 70. Probably not the worst buy in the world, but big bar, big risk. So what do traders do when there's a big bar and big risk? They buy the pullback. So traders instead bought the pullback. 71 is a third leg down. So 1, pullback 2, pullback 3. So probably not the best sell. And reversal up 72. And you end up getting a big surprise bar 74. Okay to buy, but we might find sellers here. And you want really good follow through. And you instead get a 50% pullback 75. Again, bulls not interested in buying above 74 since it's too big of a bar. Do you buy above, if you buy above 74, I thought it's really hard to sit through 75 because it's so late in the day and it's such a sensitive trade to buy above 74 that if you did it, I think it's hard to sit through 75, the doji bar. A lot of traders would just be eager to get out. But instead, we ended up rallying, trying to test that new high, 76, 77, 78. For stop orders on the day, you could buy 11. You could probably buy above 13. You can buy 14, 16, probably 19 is fine, but you're probably getting out here, I would imagine. You probably buy above 24. You can buy the breakout above the high. You can buy 30. You can buy the breakout above this high, or you can buy above 34, 35, 36, 37. This is all by the close. It's fine. And then I wouldn't touch any of this. Maybe you can sell 65, but I probably wouldn't. It's just not my trade, at least. And then you can probably buy above 74. On the daily chart, we formed something disappointing for these pairs. So I thought it was also kind of important we went outside up. Additional facts about outside up days. 70% of outside up days close in their upper third, and 70%, and they usually don't go very far above the prior day's high. So you get an outside up day, think upper third, and probably not going far above the prior day's high. But outside up day, we're probably going to test the all-time high tomorrow. I would imagine there's going to be sellers there and form some other kind of reversal down. But this was a climactic breakout, so I don't think we're going much higher. I would expect something disappointing for the bulls who are willing to buy above this tomorrow. So if we trade above today's high tomorrow, which is likely that we will, I would expect a rather disappointing follow through day. And it's Tuesday, so we'll talk about the weekly chart until later. But yep, that's it. Tomorrow is an FOMC day, by the way. I'll put a post up, but I don't trade FOMC days, so there will be no video tomorrow. That's it.